So Troika has been setting up this new exponential curve, just like I said it would. This is exactly the type of move that I said was going to happen. And at some point, we are going to hit our head on some resistance and then come back down to retest a lower level of support that we've already been at. So I'm Hello, everybody. My name's Drew Demon, and I'm the Devil's Stockbroker. I'm going to be doing a quick update on a few tickers that we've been watching for various short squeezes or at least very significant swings, and wanted to give an update on those as well as the broader market. So we'll get straight into it. So I created this thread. So I created this thread on Twitter after ScourgeBot had updated on the Troika short exempt numbers. So I wanted to get into that and dig into what these short exempts look like. As you notice, at the very end of the week, in the last 3 trading days, we had, well, actually, the entire week, we had massive amounts of short exempt volume coming through. And we saw a lot of price action to the upside and then a rip back down today. We had a significant gap down after after Troika got pushed back to the 50-cent level for support. And this was where we saw the majority of the volume hitting. So at the low today of 50 cents even, that was where I suspect that most of the short exempts were attempting to push the price below in order to get better fills and restore inventory for market makers. We'll go into the Ortex data after this, but I just wanted to point out that now that these short exempts have basically hit again, what I suspect this is a restarting of the rehypothecation cycle that we talked about in my video earlier this week on the share recycling machine, or the rehypothecation explained video. So take a look at that if you haven't seen it already, so that you understand what I mean when I talk about rehypothecation. But as for these short exempts, we've basically restarted a new T+6 cycle. So beginning February 27th, so that would be our transaction day for this 1.172 million shares that were short exempt. This is the 0 day, so we count up from here 1, 2, 3, 4, and then starting on March 6th and 7th, that would be our first T+6 settlement day. So Tuesday the 7th is our first new T+6 day, where the first batch of these short exempts are due. And then Wednesday, Thursday, Friday are when these next 3 successive trading days of short exempts are due. This assumes that the short exempts were exempted because the shares couldn't be located. So that is something to carefully consider as we move over to the next section, which is our Ortex data. So looking at Ortex on Troika, we see that currently the estimate, according to Ortex, is 121.6% of the free float. This is a massive number. We've rarely seen short interest estimated by Ortex over the free float or over the max free float, which is exactly the same situation that GameStop was in back in 2020 before they squeezed. And that was what called so much attention to that stock, was the fact that the exchange reported interest, which is still pretty low here because of how delayed exchange reported interest is. But GameStop was something ridiculous, like almost 200% of the free float. So 3 times over had the entire float been sold short. This is still a massive margin. Also worth paying attention to is the free float on loan, which is 181%. So on loan shares are borrowed but not necessarily sold short. These may be on hold for wholesaler inventory or market maker inventory. These are the institutions that fill your orders whenever you are making a purchase. And in order to fill those orders, they sell a share short to you. If they cannot locate a share, i.e., they can't borrow it because the inventory is messed up or limited, they will short exempt it, and it is exempt because they have failed to locate a share. This is only allowed by market makers who have special exemption status with the SEC. So currently, this has Troika set up for a really wild ride right now, and you can see down here the volume is going in this exponential curve fashion where the average line of the Troika volume is just curving further and further upward. I'll show this in my chart elsewhere, but the other thing to pay attention to is that we have seen a big drop in the cost to borrow for Troika, so we have to be very careful here. Suddenly, we've seen a big drop in short interest on the live reported short interest from Ortex, as well as a drop in the cost to borrow minimum. This is an indication that there may have been a new big batch of shares delivered that are available to be shorted, which has reduced the cost to borrow fees, or we may actually be seeing shares being bought back and returned. We did see a massive borrow change of negative 17 million. So this is, I mean, compared to where we're currently at, which is 54.2 million shares on loan, it's not the majority of shares that are borrowed, but it is a significant number worth paying attention to. So we have to really pay attention to this um, and don't like assume that shorts haven't covered because we had a lot of price action so far. It is possible that shorts may have covered, but we have to wait and see. It is slightly delayed data. We're not sure how delayed, but I'm estimating 2 settlement days. So moving on from here, we have TradingView, and I wanted to do some quick analysis on this chart, Troika, while I'm here. So Troika has been setting up this new exponential curve, just like I said it would. This is exactly the type of move that I said was going to happen. And at some point, we are going to hit our head on some resistance and then come back down to retest a lower level of support that we've already been at. So I'm expecting that support to be somewhere around 36 or 35 cents. That's one that we have found to be very stable. And it is common for that resistance that we run into to be the 200 period simple moving average, which is this yellow line down here, which also matches up with the 200 exponential moving average in red. That's pretty typical, but since we broke above it, I'm not sure that we're done yet. It's hard to tell. So we kind of have to. That's why I say be really careful and make sure that you are carefully watching this chart as we go into Monday. After hours this evening, I'm hoping to see Troika make another leg up. Currently, it's up at around 51.8 cents, which is it's decent. It's still holding up support at the 50-cent level, that is exactly where that moving average is sitting right below. The 200 EMA on the daily chart is sitting at around 48 cents. So we want to see this holding up at 50 cents strongly. That is putting more pain on shorts that are already in their positions and probably trying to unwind slowly. If we see more buy pressure come from retail, then it's possible that Troika might make one more leg up, but we're in the territory now where we have to consider the possibility that shorts have experienced enough pain and have been covering for the last couple of days, or at least trying to unwind their positions slowly. We'll see how things shake out on Monday. If we did hold support throughout the rest of this evening and we open up Monday higher, then I expect that to be a big signal of continuation for Troika going forward. If we get instead a pullback down below 45 cents, then I'm estimating that we're going to have to at least retest 35 cents, possibly as far back as 28 cents, where our last leg of support was sitting at. So watch those price levels and make sure that you are being realistic and pragmatic about where you're taking profit and make sure you're managing your risk. It's always important to manage risk. The other ticker that I have been watching is Bed Bath & Beyond. You guys have already seen this for the most part, I'm sure, but if you didn't get a look at this thread, I was doing a little bit of analysis on Bed Bath & Beyond, kind of eyeing up this double bottom pattern that was forming up here, and I was noticing a lot of technicals that looked especially good on the MACD and the volume direction candles. So you can see that there is a clear double bottom pattern here in the chart, and Bed Bath & Beyond is very close to its 52-week low. These are the setups that I like to look for possible liquidity squeeze situations. They always tend to happen very close to the 52-week low, so timing is extremely difficult but very important. At least I can say that the volume that we're seeing from Bed Bath & Beyond, which is slightly going up as we are working out and hammering out a bottom at around $1.50, that's where you see these setups most often. The other thing that I saw is we had lower lows on the MACD, and we're finally starting to see the MACD really fight for some upside momentum. So if we get another cross down and an immediate cross up on this MACD, then that would be a bullish signal for an entry to make on Bed Bath & Beyond. Right now, the biggest deal with this is the options chain, though. So a lot of people were complaining that I didn't discuss their bankruptcy situation. Bed Bath & Beyond does have a really messed up financial situation that they're currently working out. Right now, I'm not focusing 100% on that. A lot of people have already covered Bed Bath & Beyond for all of those reasons, especially with Ryan Cohen's involvement, and I'm happy to go into those details at a later time, but that's not the primary focus of my thesis here and why I'm choosing to uh, enter a long position at this specific price level. Honestly, like, the financials and their situation is really terrible, and as far as their business model is concerned, I have my doubts about Bed Bath & Beyond for the long term, just like everybody else. But what I see here that is so different about Bed Bath & Beyond is that, for one, their short interest is very extreme. I took this screenshot in the middle of the afternoon today, and I saw that the short interest of free float was 67%, with 90% of the float on loan. And you can see this curve setting up here, which looks very, very similar to what Troika was doing. Um, and right now, the price is still in decline, so short sellers are in a good position, but they're kind of struggling at this support level of $1.30. That's where the support line is that they're trying to break through in order to send Bed Bath & Beyond below $1. If they do succeed in pushing it below $1, then Bed Bath & Beyond would possibly have to consider reverse splits at some point in order to maintain their compliance with NASDAQ. But if they shoot back up from here, then the shorts can be in real big trouble because they basically sold the bottom and put themselves like at the worst price level to get into a short position if it reverses from here. Because once it starts going, there's really no stopping it. So they have to be really confident that this is not the bottom. And if they end up being wrong, they're going to have a hard time finding more shares because, if you notice, utilization is maxed out at 100%. Doesn't mean that they can't find more shares, but IBKR is currently showing a very low inventory of lendable stock. So they're going to have some trouble finding shares if this starts moving up and shorts try to hang on to their positions or worse, double down. So that's something to watch out for. Going back a little bit further in time, also took note of the failures to deliver. This was very extreme. The amount of failures to deliver exceeded 7.5 million on one particular day. Take note that these are cumulative, so the number of that is posted each day is the number of cumulative FTDs for that day. So if you see a reduction the following day, that means that some of those FTDs were covered. So take each day as its own individual number. That's essentially what I'm trying to say. But the point is that there was a massive amount of failures to deliver while Bed Bath & Beyond was at a pretty high price level, and I suspect it's because of the options chain. Because calls, once they go in the money, especially in huge numbers like it did, then whoever sold those calls can end up getting themselves into big trouble. So I'm also going to call out this gamma squeeze chart that I pointed out. This is something I touched on in my last video on Bed Bath & Beyond, so you guys can go ahead and check that video out and get a more concise and complete explanation of this. But what I'm basically looking at is if Bed Bath & Beyond, if its price goes up by even just $1, if it goes from 150 to 250, or my dream would be $3, then it would put more than 40% of its float in the money. So you're talking about a stock with almost 70% of its float sold short, more than 90% of it is borrowed, and the potential for millions of shares, almost 22 or almost 23 million shares by not this Friday, not next Friday, but the Friday after. That would be March, what is that? March 17th. If the price goes up to $3 ideally before March 10th, and we see all those call options expiring in the money above $3, then all of these calls go in the money, and whoever exercises them is entitled to receive it from whoever sold the calls. And whoever sold the calls, if they don't actually have shares of stock to cover those calls, they're going to they will fail to deliver. They will have an FTD, and this will put them at odds with their broker, who may start issuing margin calls if they're individual investors. But in the case of broker dealers and market makers, they'll just delta hedge. So if you want an explanation of delta hedging, check out that video that I just talked about from earlier this week, explaining Bed Bath & Beyond. A more granular look at this would be here on this image right here. You can see that there's a lot of red down here at the lower left-hand corner. Basically, this is showing the open interest on the call chain between now and March 17th. So all of these big numbers here are representing the total contracts in calls for Bed Bath & Beyond that are expiring that week. So this is what a gamma ramp looks like on a table, basically on an Excel spreadsheet. So you can see that if the price starts going up, the more of these that go in the money, the more shares that have to be covered. That can cause a runaway effect known as a gamma squeeze. So these are all the components that I've been watching with Bed Bath & Beyond, just to give it a little bit more context, and I'm just letting everybody know all of that is still intact, and that thesis is very much like staring me in the face, just begging me to take a bigger position on it. I'm trying to be more disciplined in my more recent trading strategies and not take on too much risk. But it looks really good, and I'm really happy with the setup. The technical setup itself is enough for me to take a long position, at least on a small level, and just see if I can get a few, just to see if I can get like 10 or 20% out of the stock. That would be a fantastic move. But if it does end up doubling and we get a 100% move out of Bed Bath & Beyond between now and next Friday, then that would put enough options in the money to trigger a gamma squeeze. The other one I was looking at was Carvana. Carvana actually broke very briefly $10 today. I was really hoping that it would close above $10, and as a matter of fact, it did. It was absolutely beautiful. Carvana closed at $10.09, putting a ton of options in the money. It's absolutely ecstatic today. So Carvana, I called this one out weeks ago. Carvana's had a gamma ramp that basically we just saw about 10% of its float get put into the money, and a significant number of those call options that were in the money expired today, and they expired with pure they expired with value. So most of these at $10, there was about 4,700 calls that expired today, if I am looking at my chart correctly. It's really tiny here, but we had a lot of calls that expired today in the money. That's an excellent sign. So the most significant price level for Carvana was the 10-cent strike. You can see all across, these are each 1 week or one Friday apart up until here. This is April 17th or 16th. I'm not sure exactly on the exact day, but it's the middle of April Friday expiration for Carvana. You notice that $10 strike is a significant price for it. So if it holds $10, then all of these, as long as they're all staying in the money and continue going up, you'll probably start to see the call chain start to grow here at like $11, $12, and so on every single Friday after that. As far as the technicals go, Carvana actually has a really nice setup. So Carvana had strong level of support at $8, and it wicked through it last Friday. Um, on was that? Oh, I'm sorry, 2 Fridays ago. It wicked down through the 24th of February on the $8 support, and it created a tweezer bottom. So this tweezer bottom daily candle setup was a really, really good setup. I actually took the buy right here at the, right before the close of the day, and the um, the 50 EMA was broken today. We closed above that 50 EMA on the daily, and also put all those $10 strike options in the money. Beautiful setup. It isn't as critical, but a lot of puts also expired worthless. There was a ton of puts that were opened up while Carvana was trading down here, and most of them were expiring on a monthly basis. So all the puts that were $8 and below, there was a little over 20,000 of them, if memory serves, and they all expired worthless. So shorts in the options market for Carvana got absolutely slaughtered. They lost a ton of capital on. So this actually puts Carvana in a really nice position for a leg up to retest this high. And yes, I'm not exaggerating. If Carvana's if the all chain continues to grow at the pace that it has been, and it's able to break through $12, which is the next significant price level, it really needs to break it before March 17th. That's this date here. 7,787 calls are currently open on the chain that are expiring on that date. And for that exact strike, that would be a significant leg up in the market for Carvana. So if it does break that level and close by March 17th above that $12 level, that is big potential for another leg up on Carvana. I've talked about it in the past a little bit, that Carvana is basically being bought up by its insiders, especially its 10% shareholder. Check out my previous Carvana video for a full breakdown of that situation. But insiders basically know exactly when to buy and sell their own stock. They top ticked Carvana in the market above 300, and now they are bottom ticking it within about $5 of the bottom here. They started buying as high as $20 and have continuously been buying as it has been falling all the way down to the lows of $6, $5, and $4. So the Carvana executives, they know what's up. Trust them. They know what they are doing. They have perfectly traded their own company twice now, including the bottom back when the COVID crisis originally hit. So they're buying right now, and I'm going to take on faith that they know something that we don't. And, they're insiders after all. I'm only going to briefly cover AMC because the situation with AMC honestly wasn't as good as I was hoping. Their earnings did not go as planned. The performance was fantastic as far as their box office earnings and their concession earnings. They definitely pulled in more money, but their debt is still overtaking them right now. So AMC was getting really hurt by that, and Adam Aaron on the call went on a tirade, um, kind of like almost like getting really angry and aggressive with Apes for having all these conspiracy theories about him being a hedgy plant, which I don't know why he chose to respond to this because it's really not good for the public appearance of AMC. I wish he hadn't stooped to that level of even bothering to respond to these idiots, but nevertheless, that's what he chose to do. And the stock price just kept falling in after hours after that. So the stock obviously got punished for the way that the call went. Right now, AMC got a little bit of a bounce off of the $6 level. It held support really nicely, but I'm worried that it's just going to end up forming a bear flag. And if it does end up breaking that $6 level, then it's going to have to find support somewhere at around $5. So just a quick look at that chart here. Right now, the support is here. If it does end up breaking that on a bear flag, which is what I'm concerned of, then it will probably have to retest the $5 level before it can move back up. Hopefully, we'll see something a little bit more positive coming from AMC. If it does end up reaching that level and rebounding very quickly, then it could end up forming a diamond bottom or some other bullish setup. But we'll just have to wait and see. I was also asked to take a look at GNS or Genius, Genius Group Limited. The short exempts had a massive move today when the stock popped, and this is actually a really good signal. This is the opposite of what AMC was doing, where short exempts were rising on a massive downtick. GNS had a massive pop in short exempt volume on a huge uptick, and the stock overtook. I think it was like, yeah, it was like a 60% move on the day, moving from a low of $2.11 all the way up to a close of $3.63, but had a high on the day of $4.30. So a really volatile move from GNS. I'm not in this ticker, but I am covering it just to kind of illustrate that we are watching these. And GNS is one that we've been alerting on for a long time because, as you can see, the short exempt ratio has been really excessive, over 3% every single day, with the exception of one day for the last 2 weeks. And these past 2 days, the short exempt ratio went over 10%. That's a massive margin of short exempts versus short volume. That's where this ratio comes from. Anytime we see anything over 3% for multiple consecutive trading days, we start paying attention to it. When we see something crazy like 10, 12% short exempt ratio, that really makes us like look very closely because something's going on at that point. And we know that it's just because market makers are filling buy orders. But what we look at is the direction the stock is moving, the catalysts surrounding it, and if there's a big options chain that's developed on it or some other big catalyst that could cause a violent move. And consistently, this has worked for us. So GNS is one that we've added to our radar and we're paying close attention to it. There's a lot of members of Hell's Trading Floor that are actively, swing trading it right now. And a lot of them, from what I see, they're all doing really well. But just wanted to let everybody know that I am paying attention to that one going. So the stock chart on this one is looking really nice. It did break down support this past week when it broke through at $3 level. So it found support at 220. That's going to be a significant level of support in the future, and I think it lines up with the initial breakout level when it was moving back on the 20th of January. So if GNS ends up doing this big move and creates a parabolic arc pattern, that is what this sweeping pattern looks like. It hasn't done a confirmation move yet, but this candle is the initial signal of a potential parabolic arc. This actually is a very rare trading pattern that occurs on technical charts in the stock market, and it's universally very bullish. And when it does show up, it tends to be very accurate because of its rarity. So Genius is worth watching. I'm not personally going to take a position in it, and I advise everybody to just be cautious. Always be cautious and manage your risk appropriately. But this one's already got a lot of retail eyes on it, and institutions have been taking note of it too, from what I understand. The volume direction candles are very bullish. The move here shows that there's a plateauing effect occurring. And if you pay attention to on balance volume, OBV, this is basically the same thing with just a little bit more detail on volume versus price action volatility. And if it gets a bounce off of this moving average right here, then that big pop in volume would signal another move just like this. So if that does end up coming true, then next week, if you see the price start to do a V-shaped recovery like this, you can capture that move from $3.60 all the way up to probably around $8 is where the first resistance is. If it breaks that, then I have no idea where it could get to, but take note of like past resistance levels and you should be able to figure out for yourself like what are likely areas where it will stop at, somewhere like around $10 or $12 just based on the tops of these candles right here. That's a good indication of what future resistance looks like. I'm going to go ahead and wrap up with the overall market trend. So, kind of want to explain what's been going on with the SPY and elsewhere. Things got really crazy because Fed Speaker Bostic went he went on record for an interview where he was asked if he was in favor of a 25 basis point hike. Basically, they were trying to ask him, is the Fed going to pivot? They were trying to like box him in and get him to answer a question that in any way would indicate the Fed's likelihood for dropping their rate hikes to a lower interest rate increase per rate hike. And what they wanted to hear was 25 bips, 25 basis points, meaning 0.25% of an interest percentage. So he said yes. He says, I would be in favor of a 25 bips increase, but I would need to be guided by the data. And that was an important piece of context that I think the market really ignored because the data he's talking about is inflation data. But nevertheless, as you can see, SPY had a huge, huge move as a result of that. So you can see that right now, SPY and the high yield grade bonds are both moving up as a result of that. I'm expecting that the SPY is probably going to try to recapture around 410 or 420 before it gets knocked back down. So pay close attention. I do like to use the SPY and HYG ratio charts because it's a great indication of what bond traders think versus what market traders think. Bond traders being institutions, they tend to know what's going on before everybody else has a clue. So for that reason, I pay close attention to this chart. And what I've noticed is that there is this clear level of resistance on the actual ratio chart. That's what this chart is. This is the ratio chart itself. And I have this resistance marked out. So if I see the SPY and HYG ratio chart hit this level and then get rejected, that's going to signal to me that the market is getting ready to rug pull everybody. Basically, like when I see this bear flag forming on the ratio chart, I expect that to indicate a big rug pull. And in order to detect this, all you have to do is look at the HYG, that's the high yield grade bonds ETF. And if you see the SPY moving up, if SPY is going up intraday, then HYG starts going down like crazy, then the bond traders think the market's going to go down, and they're probably right. 9 times out of 10, bond traders know what's up. The SPY traders, the retail investors, the small time institutions, and hedge funds without access to insider information and stuff like that, they don't really have a clue for the most part. So that's how you trade this chart. And as you can see, I have these MACD crossovers circled here. We've already had one crossover. One thing I'm going to point out is that every single time we have had this top on the market, there has always been at least one attempt for the MACD to try to make a bullish crossover every single time. And it usually happens within the first 2 weeks of the move to the downside in the bear market. Notice it happened here too. Back in April, it happened back here in September, and it happened again in December. And every single time, it juked people out. These moves, these big bullish moves that everyone was like, "Oh yeah, it's not so bad," they got screwed. Every single time they tried to do this, they tried to be smart, they got messed up every single time. So this is a setup for a big bull trap. I would say be very careful. I could be wrong. None of this is financial advice. I am an amateur. Please understand that. But this looks like a big setup for people to get rug pulled. Don't be a victim of Wall Street. Don't be their target. Stay liquid, keep yourself safe, and look for confirmation of what the move is. If we get a breakout on the S&P above 415, then you can say True Demon's wrong and it's going to the moon. Fine, I'll go ahead and bow out. But until you see confirmation that a bull market has returned, do not trust the narrative that the Fed's going to pivot or a move to the upside is imminent and suddenly everything's going to be all sunshine and rainbows, because so far it's not. Every single time there's been this stupid euphoria in the market where everybody is promising all this glorious, magnificent price action to the upside and how the market's saved, even though inflation is still ridiculously high. And by the way, the dollar index forming a giant cup and handle None of these signals mean good things. If you see this kind of a formation and dollar, the Dixie, starts ripping to the upside, that means that the bond traders who are selling the market already know what's going to happen, and we're not done with the inflation problem, we're not done with the bear market, we're not done with the crash. So look at these other signals. Don't just focus on the SPY. If you focus too closely on just the SPY, you're going to get rug pulled. Always pay attention to the other macro factors that are happening so that you avoid becoming a victim. Okay, last two tickers, and then I promise I'm going to shut up and let you guys get back to your life. XLRE, this is the Housing Sector Real Estate Index, or the REIT sector. This is currently forming a big topping pattern, and we saw a bear flag starting to form today, which this thing tracks the SPY pretty closely, but it's mainly focused on property values, residential mortgage-backed securities, and commercial mortgage-backed securities. So this market has been moving up for the last couple of days. Why is that? It's probably because of Bostic and his big fat mouth saying that he would be in favor of a 25 bips hike. Everybody loved it. They swallowed the pill and they went with it. XLRE is moving up as a result, but this is not in line with the fundamental situation with the housing market, as well as the fact that BlackRock just defaulted on a massive scale of commercial MBS of Nordic properties. If you did not see this story, you should pay attention. Blackstone defaulted on a $562 million commercial mortgage-backed security, or CMBS, contract. This is a big deal. It was specifically in real estate that had mortgage-backed securities backing some property in the Nordic regions in, I believe it was Norway. This default was their choice not to continue to pay interest rates on these bonds. So this is a big deal because it means that Blackstone decided that it was more cost effective for them to go into default on these contracts rather than continue to make payments on them and hold on to their positions. That suggests that they think they're worthless. And what that suggests is that property values in Europe are starting to fall very fast. This is not a good sign. It doesn't say anything specific about the US market, but it does have some things to say about where the overall global market is going. And right now, everybody is really scared of inflation, and the real estate market index has been threatening to make a move to the downside for quite some time. Go over to the weekly chart really quick right here. You can see that we have been legging up twice, and then we had a big move to the downside. If this thing rounds out, then it's going to form a head and shoulders, and it's going to break that 38 level so fast it'll make your head spin. By the time that we're done with the next 3 months of market trading, I'm expecting XLRE to be testing $33 and $34 price levels. Now, how I'm taking advantage of this is I'm not actually trading XLRE, I'm actually trading DRV. DRV is an inverse leverage index, or a ETF, excuse me. This one trades based on what XLRE is doing, and I took note that the market really pummeled this one after that news. So I took profit on my DRV position so far, and I am just waiting in cash for DRV to make another move to the downside and go retest support at around probably like $43, $44. And because this is a leveraged index, or a leveraged ETF, I keep saying index, this thing has a lot of power behind it. It's also very expensive, but it's less expensive than buying at the money calls for very, very far dates for XLRE. So if you think that a move is going to happen in the market and you think it's going to be a big bearish move in the real estate market within a month or 2 months, you can get calls in DRV. And when XLRE goes down like this, DRV goes up 3 times faster, like that. So that's why I pay attention to XLRE, and that's why I look for big moves like this, which we caught back in August. Hell's Trading Floor bought the bottom of this, and we moved up by, what was this move exactly? We bought the bottom in in mid-August. We traded this all the way through the end of September. Yeah, 95% move on this ETF, which is insane. And the options on this have crazy IV. So if you are an options trader and you like to trade with leverage, this thing is like leverage upon leverage. So just be aware that it is a risky endeavor and these options are expensive. I do always advocate for risk management, but this one, as far as leveraged ETFs go, is pretty reasonable as long as you are accurate with your timing on real estate market moves. So that's going to be it for this video. I hope you guys found this information helpful. If you like this content, please be sure to leave a like on the video. Helps out the algorithm and helps out me to let me know that you're enjoying what I'm giving you. Subscribe and hit the bell icon if you want to see more. And if you are not a member of Hell's Trading Floor already, consider joining us at hellstradingfloor.gg/hellstradingfloor by signing up through our website at hellstradingfloor.com. Thank you guys again so much for watching, and I'm looking forward very much to seeing you on Monday. Until then, have a hell of a time in the markets, and have a hell of a weekend.